Hello traders, Gary Wagner here. It is approximately 11 a.m. Wednesday in Honolulu, Hawaii. It is the 28th day of September, and this is the daily report for gold. We have gold under significant pressure again this morning, currently trading off, and in terms of the amount on the day, trading at 1608, puts it down about $40 on the day. That's correct, $40 on the day. We did move our stops up yesterday. And to give you an idea, we moved them up to 1630, got in at 1620. When the market came down, it did appear as though it almost hit us, but when we blow this chart up, you will notice that in fact we did get away from getting hit on the stop. As the market moved higher, that rally was not to be sustained because we were stopped out with a very small profit, about a $10 profit on the trade. But I have decided at this point, with the type of activity we're seeing in the market, I will not let any profits get away from us, even if it's small. I do not want to incur any more loss. We are looking at a candlestick chart. It is a daily candlestick chart, and it is of the dollar index. And what is significant on this chart is really just around the beginning of September, the end of August, you can see that the market bottomed just below 74. This is a basket of currencies against the US dollar, and it has gone from 74 to almost 80 in terms of a straight move. This strength in the dollar, of course, is an inverse correlation when we take a look, of course, at gold. Because when we take a look at gold, from the end of September, as you can see here, you get that inverse correlation. As the dollar has been moving up through September, gold has been moving down. Traders, at the same time, when we look at the crude oil market, and this is a daily chart of the November contract of crude, November 2011, you can see the various tops that it hit. This was that record high that we got back in May of around 116. Market comes down, lower top at around 104, still above 100, but then it broke down, hitting a low just at about, say, $76 per barrel, is currently trading at 81.21. That on the day, as you can see, is much lower, trading down about $2 on the day. Traders, we currently have gold trading at about 1611. It's trading off of the lows, but certainly not exhibiting any sort of a rally. We need to take a look to see how it reacts here. The fact that it has gone lower, we might see a drifting back towards 1600. We want to remain flat during that. Over the last couple of days, I have done a study that I thought might be interesting and worth us noting. And simply what I've done is looked at Fibonacci extensions. And the way that I did it is I took a look at the big picture. This is a daily chart. This is the continuous contract of COMEX gold. And as you can see, it begins at this rally, which started, I think, the Super Bull rally of 2008. And what I've done is I create my first level or rise, and then from there I run an extension. I do the same after we get our ABC retracement for this second rally, and then for this third rally. Now, what I found was interesting in terms of the information that it gave us, when I ran a Fibonacci extension from 700 to about 1235, the 38% extension level corresponded exactly to the top of the next rally, and a 123% extension put us within dollars, literally dollars, 1890 topping 1920, put us within dollars of this last rally that we experienced. Now, the second set of Fibonacci extensions that I did comes off of this rally, which starts in 2010, roughly in February, takes us all the way to November, so 1050 to 1140, and that puts us here. And when we run our Fibonacci extensions, a couple of interesting things happen. First of all, the 123% extension takes us exactly to 1919, exactly to the top of the market. Then when the market corrects, interestingly enough, the 23% extension is 1534, which is exactly where this correction took us to. What does it mean? Well, what it tells us is that there is an absolute underlying pattern during this bull run. If, and it's a big if, but if this pattern holds, what might we expect in the future? And that's the reason for me doing this. And this is basically what I come up with. If, in fact, we get a reaction similar to these last two Fibonacci extensions and rallies, we could see this market go to about 2156 on the conclusion of the next rally. In other words, we get our ABC pattern here. In conclusion, we go back into an impulse phase. That would take us to around 2156. And then just as this Fibonacci extension gave us 2 out, if we were to go 2 out, which will probably take us towards the end of 2013, and I believe the end of this bull cycle, it would take us roughly to 26.76. It's a big jump. I'm more looking at this as being appropriate, 21.56. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.